Okay, folks, welcome to Swing Trading today. This is Bob Desmond, and we're going to begin with a bit of an announcement. Later on this afternoon, I will be doing an interview with Jake over at TrendSpider, and he's going to be introducing us to raindrop charting. And I was on a conference call with the management over at TrendSpider a few weeks ago. We did a screen share, and we were talking about raindrop charting, and it's a mixture of candlestick charting as well as VWAP, and that's essentially volume weighted price action. And it was interesting. I'll say that. So I've been digesting it of late, and Jake said, "You know what? Let's do a interview, a webinar, seminar, whatever you want to call it." A demonstration, that's probably best. A demonstration of raindrop charting with your followers, and that's what we're going to do today. So that'll come out either later on this evening or tomorrow. Just subscribe to the channel and don't miss it. Okay, so yesterday we had a big pullback in gold and a big rally in the stock market. That was no shock. I mentioned that on best stock charts over the weekend, that was what we should expect. And our position in the financials did well. We expected a breakout in the financials, and we got that breakout. We expected a pullback in gold, and we got that pullback. So how did we manage that position? Well, what we did yesterday on the NUGT trade, we took a portion of that position and we sold covered calls. When I sell covered calls, I like to stay very, very short term using the weekly out of the money covered calls because the time decay is just so rapid, especially since this is an abbreviated holiday week. So we have a light volume week. It's abbreviated. We opened the trade late yesterday afternoon. So for all intents and purposes, we only have 3 trading days left in the week for those options to expire worthless. And if they rally up and through $25 per share, which is a strike price that we executed, well, we'll have those shares called away from us, but we still have a very large position and we'll still be long. And if they do not close by Friday afternoon above $25 per share, we capture that premium and we take our wives out to dinner, and a very nice dinner at that. So that's how we're managing the NUGT trade right now. Longer term, still bullish, and I would not be a seller of covered calls were the shares of NUGT in a downtrend. You don't sell covered calls on a stock in a downtrend, only on a stock that's in an uptrend. And I'm talking on a weekly and a monthly basis, not on a daily basis. Unless, of course, you're going to sell those covered calls with a duration 3 months or longer, bringing in a big fat premium on those calls. But that's not my style. So let's move on to a headline I want to discuss. And it's really a headline that you continue to see in some form or fashion, whether it be domestic or globally. The global economy is slowing. And you could say that it's because of the tariffs, the trade war. It's not. It's because of debt. There's too much debt out there, and it's stifling growth. It's stifling the economies of the world. And what's their solution? They're going to add more debt. So today's headline, this is actually from yesterday. Global manufacturing PMI crashes to 7-year lows as new orders slump. 7-year lows. And when you take a look at this chart, JP Morgan Global Manufacturing PMI, you could see that the last time we began to rally was back in 2015. And oddly enough, back in 2015, what happened? That was the beginning of the rate hike cycle. And then as you could see, we peaked out at the beginning of 2018. And ever since, the Federal Reserve has been very cautious about raising rates. And now they are alluding that there may be a rate cut and eventually a return to quantitative easing. But this is all a temporary fix. And when you take a look at the global manufacturing PMI summary, this breaks down month over month, May versus June, global PMI falling faster rate, output falling from rising, new orders falling faster rate, New exports falling, faster rate. Employment falling, faster rate. Input prices rising, but there's no inflation. That's what they tell us. There's no inflation. Even the Federal Reserve. Our own Fed chairman said he was disappointed with inflation during his last press conference. Output prices rising, slower rate. Future output, positive, lesser extent. And this is a chart that really tells a story. The bond market, which is overlaid here in blue, and then you have the JP Morgan Global Manufacturing Index, which correlates very, very well with the bond market, bond yields, I should say. They're dropping like a rock. You have the stock markets, which are rallying on hope. On hope. What's their hope? That they're going to get more of an injection. Because traders, especially institutional traders, are junkies. They need their Fed fix. They need that shot of heroin in order to keep this party going. And the financial news media elite, they will spin a negative into a positive for the stock market like nothing you've ever seen. And that's going to continue. So, in closing, this is a snapshot of the environment that we live in right now. We have yields which are dropping. The markets are sending us a signal. You have an inversion of the yield curve on the shorter duration bonds, yet the stock market is making all-time highs. But I will add this, is that yesterday, while we did rally, we got that right. We knew the market was going to rally. They were going to spike the futures on Sunday night, which they did. The markets opened up positive on Monday morning, but they did not close at the highs of the day. They closed well off the highs, and volume was not the greatest. Let's get to the pre-market activity. We'll begin with the 10-year Treasury note. This is a 4-hour chart. These will all be 4-hour charts. And you can see that we are consolidating very, very nicely here. And in all probability, we are going to break out on the 10-year Treasury note. What will that do to yields? They will be pressed lower. So if the economy is so wonderful, why do you have money flowing into the bond market for safety? So we will be looking for a resolution to this downtrend on RSI. That will set the stage. It'll send us a signal that we should expect a rally in the 10-year Treasury note. And of course, that'll press yields lower and force stocks higher. Let's skip over to Bitcoin. We booked profits on Bitcoin yesterday. We're still long of Ripple, and we'll look to add to that position. But Bitcoin, we had a 10.5 price target on it. This is gold. We'll come to gold in a moment. We had a 10,500 price target on Bitcoin. And thank goodness that we booked profits here because we did continue lower. Once we cut through the support level here, we had to get out. Where might we find the bottom? For all I know, it could be 10,000. And if it does break the support level, we could come all the way back down here to an 8,000 handle. So just be very, very careful here with Bitcoin. Right now in the short term anyway, the path of least resistance is to the downside for Bitcoin. Let's take a look at gold. Now, gold, which again, we mentioned over the weekend, we expected a pullback. We certainly got that pullback. We're seeing a pop higher this morning. I don't think that we're going to do much more than what we have right now. Again, it's going to be a light volume week. It's a risk-on environment. And when you have a risk-on environment, people want to own stocks. Gold is a safe haven play. So right now, we're vacillating in this downtrend channel. We have a double bottom setup on the RSI. We broke out on RSI, and in fact, we're now pulling back and retesting the breakout point. We'll see whether or not we get a follow through to the upside. I wouldn't be surprised if we didn't. And in all probability, we'll vacillate here between 1,400 and 1,350 through the end of the week. Taking a look at silver. Silver is not looking good here. Silver broke the uptrend line yesterday We rallied in an effort to recapture that uptrend line, and we are now being rejected at that level. So we're long of silver. We're going to remain long of silver, but in the short term, it's a watch. And we'll look to add more when the price stabilizes and not before then. Moving over to the S&P 500. The S&P is about flat on the morning. You can see on this 4-hour chart yesterday's price action. Here's your gap higher on Sunday. Monday morning, a fade. While we still closed up on the day, this is a tell that you had institutions out there that were taking advantage of the liquidity, and they were selling strength. So what we have here is a triangle formation, and we will be looking for a breakout to the upside here. Now, if we fail and we break below this lower band of support, the next support level would be at 29.31. But I think that in all probability, we're going to break out to the upside here, especially if the bond market breaks out to a new high. Let's take a look at the NASDAQ. NASDAQ's pretty weak, down 14.5 points. We rallied up into prior support. It's now going to act as resistance. So we'll see whether or not we stabilize here. Consolidate sideways. That'll set the stage for a continuation move higher. But watch for a break to new morning lows, because if we get that, we can come all the way down here to fill this gap, which opened up on the 30th. So just beware. And that is it for this morning, folks. Everybody have a profitable trading day. And remember, trade the charts, not the story. Be well.